U.S. PC insurance industry is expected to post an underwriting loss in 2017, marking its second consecutive year. While the deterioration in 2017 results should be more significant given the activity in the last two quarters, the segment remains well positioned according to AM Best U.S. Property Casualty Review Preview Report. Here to discuss the report is Managing Director John Andre. And John, 2017 on its face appears to be a watershed year. We had wildfires in California, hurricanes in Florida, Texas, and Puerto Rico. Can you explain, however, from a balance sheet perspective, why this may not be the case?
Sure, John. Thank you. 17 was certainly a watershed year, as you described, from the string of catastrophes, from floods to hurricanes to wildfires and mudslides, and it caught everybody's attention, and particularly in the latter part of the year. And certainly these events were broadcast into people's living rooms on a nightly basis. And certainly is a big financial loss to the industry, but it did prove why insurance is so important, as insurance helped to put people's lives back together after these events. Probably less publicized in 2017 to the general public, but certainly of note to the industry professionals. It was the continued problems in commercial auto and private passenger auto. Despite these events, but due to the size and scope of the industry, which, as you know, runs a gamut from some extremely large mutual and stock companies to smaller, hundreds of smaller, more localized niche writers, the industry on an aggregate basis remains certainly resilient and very well capitalized. We estimate that the overall statutory industry will grow surplus by approximately 2.5% at year-end 17 to finish at $738 billion. This is about a 22% gain since year-end 2012. Coincidentally, this growth matches the percentage growth in net written premium written over that same period. So if you take a very rudimentary measure of leverage, writings to surplus at 0.75 to 1 at year-end 17, we approximate, is roughly what it was in 2012. So again, I think it's just another broad but very, very good indicator of just how well capitalized the industry is. And you can't talk about surplus growth without talking about the impact of investment income. While yields have been depressed for a number of years, just the sheer size of the invested asset base has produced nearly $49 billion of investment income, which is $20 billion more than the underwriting loss in 2017, and was principally responsible for that $18 billion or 2.5% growth in surplus at year end. Now, again, I'm talking in aggregate. It's not to say that certain companies aren't challenged from a balance sheet perspective, and that's part of our rating analysis, certainly, as we go throughout the year.
John, what impact do you expect the 2017 results will have on 2018 and moving forward?
Yeah, it's interesting. I think it's a capital strength not only the U.S. sector, but certainly of the global companies that write U.S. sourced PC business will probably curtail any broad market hardening from happening. Many thought that reinsurance rates would impact primary pricing, but what our team has seen so far at January renewals, only the true loss-affected accounts saw substantial rate increases, while most other reinsurance rates are either flat or down. And now, as a result of that, primary rates will or have kind of followed suit. Again, the loss-impacted areas, but the standard rates kind of holding their own. So at the end of the day, there's still a lot of supply out there. So the industry combined ratio we expect to finish year-end 17 is about 105.1, which, despite all the problems of last year, is 4 points worse in 2016. But there are a couple key classes that continue to underperform. I should back up, John, and we keep saying estimated. Again, we put our report together, which, by the way, was available on February 6th, and I encourage everybody to pull it off the website. But we put the report together December into January. So at that point, we're estimating year-end 17. We'll have more accurate 17 information over the upcoming weeks, and that'll be published in some form by our people. So, but anyway, going back to the three lines of business, talk about homeowners. Given the rate increases in the more impacted areas, the re-underwriting efforts by many companies, and an average catastrophe year that we expect in 2018, we think homeowners will improve to a 97 combined ratio this current year, 2018. While it's still high for the short tail class of business, it's a 10-point improvement over what we expected homeowners to have put up in 2017. Another major underperformer, and it has been for some time now, has been private passenger auto, which is clearly the biggest line of business on the PC side with about 40% of the volume of the U.S. sector. The combined ratio has been on a multiple-year upward ascent for a few years now. with some improvement expected in 17 and 18. Severity has risen significantly over the past number of years due to medical costs, inflation, rising repair costs of increasingly complex cars that we've all seen, and distracted driving claims. Now, rated companies have used this experience to get some pretty healthy rate over the past year or two, and which is very difficult to do. As you know, the auto is very highly regulated. Other carriers are doing a better job of tiering their risk to make sure they get the appropriate risk for the appropriate type of insured driver. So given the size of the personal auto line, though, because it really, at 40% of the whole market, that number really moves the needle for the whole sector. Overall PC results won't materially improve until you get some pretty heavy improvement out of private passenger auto. And we don't expect a whole lot of improvement this year, a bit, but not nearly enough to move our projections for 18 to a sub 100 combined ratio. And I think lastly is, and again, the industry is very keen to the commercial auto issue, and it's only 6% of the total market, but it's been very problematic for years. Some of the same issues that impact private passenger auto has impacted commercial, distracted driving for one. The infrastructure issues on America's roads and highways that, there's some talk of that being repaired. Underwriting losses were $745 million in 2011, and now over $2.9 billion in 2016. In 17 will be roughly about the same, we figure, for this line. It's easily the worst performing line that we have. We expect a combined ratio in 2017 of 112.6. There's been substantial rate increases over the past few years. We've seen some slightly improved accident year performance. Distracted driving has decreased to some degree, not only for commercial but for personal auto. And so we're starting to feel a little better about this line going forward. So based on these late trends in 17, the underwriting initiatives planned by our rated carriers and a little bit of crystal balling, we predict improvement in the underwriting performance for each of those three major lines in 2017.
John, what are your projections for operating results for 2018?
We're right at 100 combined ratio in our 2018 projections. I got to state that we made these projections December to January, so they could move a bit, but our projections are usually reasonably accurate, given that we do them so far in advance. Much of this, of course, depends on the weather. And now our projections include a more normal cat year, adding 4.8 points to the result. The actual result in 17 was 8.8 points. So we're taking a more traditional cat year, and hopefully, touch wood, we'll see it this year. So the 4.8 is more realistic to what we've seen in the years prior to 17. On an overall basis, though, we still expect a small operating loss at year-end 18 that we currently project.
John, what is AM Best's outlook for 2018 for the U.S. industry as a whole?
Well, there's a few things. First, for the first time this year, and you'll see in the preview report, we have a line of business outlooks. But more specifically for the class outlooks, which we've been doing for years and years now, commercial, reinsurance, and personal, we have established outlooks, and they've been published for weeks now. Certainly the commercial and personal line segment, as the reinsurance segment, U.S. or globally, both, because the reinsurance obviously is a very global play. They're certainly very well capitalized, and we see the commercial and the personal segments benefiting from excess capital, pricing improvements, the current reinsurance terms and conditions, although that could vary based on the 17 results, and appropriate and certainly recently tested ERM for the personal and commercial lines carriers. We feel they continue to innovate their product offerings, and they more and more leverage the use of predictive analytics. Accordingly, we have stable outlooks on both of these broad segments, including commercial, the first stable outlook in a few years now. We had been negative for some time. On the other hand, the reinsurance segment, while certainly well capitalized, faces more pressures, and particularly from the competition forged by the growth of third-party capital. As a result, the earnings are under pressure, and the outlook for the reinsurance segment, not only U.S., but globally, remains negative. But as you can tell, and our ratings in general are always more about capitalization. Performance, of course, profile, managing volume risk, reaching customers efficiently, price monitoring. The list goes on, and these are the things that we monitor during the course of the years as we evaluate the many companies we rate globally.
Thanks, John.
Thank you.
As John Andre mentioned, you can find the full report online at ambest.com. For AM Best TV, I'm John Weber.